Imagine a world where the very money you trust, the money in your bank account, isn't really yours. Where every transaction, every loan, every penny you earn quietly binds you to a system you barely understand. A system designed not to serve you, but to ensure your dependence. Today, we're going to uncover the moment global money shifted from being a tool of exchange to a weapon of control, and why that change still dictates how billions live today. Money was never just currency. From the earliest coins minted in Lydia to the first banknotes in China, money was a representation of trust, value, and mutual agreement. But as societies grew more complex, so did the systems that managed it. Enter central banking. Powerful institutions that promised stability, but quietly gained the ability to create wealth out of thin air. Names like the Bank of England, the Federal Reserve, and the Rothschild dynasty began to shape economies not just locally, but globally. At first, it was subtle. Credit systems emerged, fractional reserve banking spread, and governments embraced debt as a tool to fund wars and infrastructure. On the surface, it was progress, but behind closed doors, a pattern was forming, a method by which money could bind entire populations to a cycle of dependence. The turning point begins in the early 20th century. The world had witnessed the chaos of multiple financial panics, from the Panic of 1907 to the hyperinflation in Weimar Germany. Governments and bankers realized that by controlling the supply of money, by controlling credit, they could shape societies in ways no king or general ever could. Fractional reserve banking became the key. Banks no longer needed to hold 100% of deposits. They could lend 10, 20, or even 30 times the actual money they held. In theory, this fueled growth. More loans meant more investment, more industry, more jobs. But there was a hidden cost. Each loan created a debt obligation, binding individuals, businesses, and nations to the bank. And as loans expanded faster than actual wealth, dependence grew silently, like a shadow over the global economy. Key figures of this era understood the leverage. J.P. Morgan, Montagu Norman, and the architects of the Federal Reserve realized that debt wasn't just a way to fund projects. It was a way to ensure compliance, to shape behavior, to create a system where money itself was the leash. By mid-century, the world had fully embraced fiat money, currency backed not by gold, but by trust in the state. The gold standard, which had limited reckless money creation, was gradually abandoned. What happened next was almost invisible. Governments began running deficits routinely, creating national debts as a matter of policy. Citizens became accustomed to borrowing mortgages, credit cards, personal loans. Entire generations grew up thinking debt was normal, inevitable even. Internationally, institutions like the IMF and World Bank began extending credit to developing nations. Loans came with strings attached, structural adjustments, austerity measures, and economic dependency. Countries were no longer just trading goods. They were trading autonomy for survival. The lesson was clear. Control the money supply, and you can control societies without firing a single shot. The cycle of debt had become self-reinforcing. For the first time in history, money wasn't just a medium of exchange. It was a tool to ensure compliance, to guarantee dependence. But every system has a breaking point. By the 1970s, the world witnessed it firsthand. The U.S. abandoned the gold standard completely in 1971 under President Nixon, ushering in a new era of fiat currency. Inflation surged, oil shocks destabilized economies, and the global debt spiral accelerated. Corporate debt, government deficits, consumer loans all skyrocketed. Ordinary people felt it. Wages stagnated. Costs of living rose. Savings lost value. Meanwhile, financial institutions grew ever more powerful, insulated from the consequences of their own risk-taking. History shows a clear pattern. The more money can be created at will, the more ordinary people are trapped in cycles of dependence. Crises are inevitable, but they are also profitable for those who control the system. And the shocking part, every so-called fix simply patched the cracks without changing the underlying design. Central banks would lower interest rates, governments would inject liquidity, and the debt cycle would restart, bigger and more entrenched than before. Fast forward to today. Global debt exceeds $300 trillion. Every country is in some form of deficit. Student loans in the U.S. have become generational burdens. Home ownership is increasingly unaffordable. Entire economies teeter on the fragile confidence that tomorrow's money will hold value. Financial crises from 2008 to the COVID-19 pandemic follow the same patterns. Mass debt accumulation, speculative bubbles, and then catastrophic correction, only to be followed by more debt. Citizens and nations alike remain dependent on a system that rewards the few at the expense of the many. Even technology, AI, and automation, which promise liberation, are integrated into financial systems that extend and deepen this dependence. The same mechanisms that once trapped nations in cycles of debt now operate on a global, digital scale, making escape increasingly difficult. Attempts to break free from debt cycles have always failed, or only worked temporarily. Countries that tried debt forgiveness or alternative currencies faced economic retaliation or collapse. The 2008 financial crisis bailout is another example. Ordinary taxpayers bore the brunt while banks and executives were shielded, and the patterns repeat. Every crisis teaches the same lesson, but society forgets. Inflation rises, central banks intervene, debt balloons, dependence grows. Digital currencies and fintech promise innovation, yet most are still tethered to central authorities who control supply and value. Global household debt is $50 trillion. Total U.S. student loans are $1.7 trillion. Total U.S. government debt is $33 trillion. 80% of people live paycheck globally. These aren't anomalies. They are evidence of a system designed to perpetuate reliance on money that can be created or destroyed at will. So what can we learn from this hidden history? 3 critical takeaways. Money is not neutral. It is a tool wielded to shape behavior and dependence. Debt is the mechanism, both for governments and citizens, creating invisible chains over generations. Awareness is power. Understanding these cycles is the first step to reclaiming autonomy in a system designed to make you dependent. The question isn't whether this system can collapse. History shows it will. The real question is whether individuals, nations, and societies can act before dependence becomes irreversible. Will we continue blindly trusting money as if it is real wealth, or will we seek to understand the invisible forces controlling it? If this video opened your eyes to the hidden mechanisms of global money, subscribe and hit the bell icon to explore more secrets behind finance, debt, and economic power. Share this knowledge, because understanding is the first step toward freedom.